Money Management Skills Part 1: How Your Financial Brain Deceives You. In the silence of the night, a man was looking at his salary message repeatedly. The money had come into the account, but there was no happiness on his face. Only one question was revolving in his mind. If the income stops today, how many days will my life last? EMI, rent, children's fees, parents' medicine, and my own future. Everything stood together in front of him. The fear begins right here. A human being keeps earning money, but he never even realizes where the money is actually going. And the curiosity is that many times, the problem is not in the income, but in the decision-making brain. What age have you thought of for your retirement? Is taking a house on rent right, or buying one? Is your monthly budget really under your control, or do you just make an estimate by looking at the remaining amount at the end of the month? Do you know your net worth? Meaning, how much do you actually have, and how much burden is on you? If the answer to these questions is not clear, then your financial life might look normal from the outside, but can be weak from the inside. Financial planning is not a boring topic. It is that silent protection which makes you a little strong in front of the future's uncertainty. Life can go on without planning, but it often does not move in the right direction. Many people think that money management means just saving money. Reduce expenses, stop eating out, stop shopping, and life will become secure. But the matter is not that simple. Managing money means understanding it, when to save, when to invest, when to spend, and when to stay away from a shiny offer. This is the real skill. Michael Finke's Money Management Skills begins with this very thought. This course tells us that personal finance is connected less with the calculator and more with behavior. Because money is in numbers but decisions are in emotions. Finke has been a researcher connected with personal finance and retirement planning. The focus of his work is not just where money should be put, but also how a human being behaves upon seeing money. This very thing is important because today an employee too is under financial pressure, an entrepreneur too is afraid of cash flow, a student too thinks between loan and career, and parents too remain in tension regarding the children's future. If money comes into your house, gets spent, remains, or chases you back by becoming debt, then money management is for you. This is not just a subject of rich people, but a life skill for every earning and non-earning person. The first lesson begins with understanding our financial brain. From the outside, we feel that we spend every single rupee after thinking carefully. But the truth is that many decisions we take not by thinking, but by feeling. Suppose a bonus suddenly came into your account. On that very day, an ad for an expensive watch appears on the phone, or a trip offer comes in front of you. The brain immediately says, "This is extra money, enjoy a little bit." But is that really extra money? That too is the money of your hard work only. The only difference is that you consider salary a responsibility, and considering the bonus a reward, you spend it quickly. Behavioral finance explains this very hidden pattern. Our brain does not always see money in the same way. It puts salary, bonus, gift, refund, and profit into different boxes, whereas money in value is the same money. This very thing is called mental accounting. The brain creates invisible accounts inside itself. One money is for home expenses, the second for traveling, the third for investment, and the fourth for the let's have some fun category. This trick can sometimes be helpful, like keeping an emergency fund separate. But this very trick can be dangerous too, if you buy a luxury item from a bonus while holding credit card debt. Now the question is, why does this happen? Because our financial brain is not a completely logical machine. Fear, greed, comfort, regret, and social pressure keep working constantly inside it. You must have seen, when the market falls, people sell investments in a panic. Those same people, when the market rises, fear that the opportunity might slip away from their hands and put in money without understanding. Right here comes loss aversion. The pain of loss feels stronger than the happiness of an equal profit. As much as the happiness of earning 10,000 rupees is, the fear of losing 10,000 rupees can feel far heavier than that. Because of this fear, people many times run in the wrong direction. Someone holds on to a falling investment just because they do not want to accept the loss. Someone sells a good asset because they got nervous seeing a temporary drop. Loss aversion does not appear only in investment. It appears in business too. An entrepreneur does not close a bad product line because he has already put money into it. He tries to save the past cost, not the future. This happens in buying a house too. Someone liked a property, gave the token, then flaws were seen. But the person says, "Now we have come this far ahead, how can we step back?" This is the emotional trap. The biggest trick of the financial brain is that it gives us a logical reason for our decisions, From the inside, emotion takes the decision, and later the brain makes a beautiful explanation for it. A man buys an expensive car and says, "This is for family comfort," but in reality, perhaps the decision came from status, comparison, and excitement. Comfort could have been given by a small car too. The beginning of money management does not happen by judging yourself. The beginning happens by accepting that we are humans, and humans make financial mistakes. A mistake is not a matter of shame. Not understanding the mistake as a pattern is the danger. If your money gets finished before the month end, then the problem cannot be of income alone. It is possible that your spending is emotion-driven, and the budget is made only on paper. A budget does not mean punishing yourself. A budget means telling your money its job. Giving direction to every rupee that you will go into rent, you into saving, you into investment, and you into lifestyle. When money remains in the account without direction, it slowly begins to leak. Small subscriptions, food orders, impulse shopping, unnecessary upgrades, and at the end of the month, the question remains, where did so much get spent? Therefore, the first step is awareness. For 1 month, you just keep a record of where the money went. No judgment, no guilt. Just see the truth, because only when the truth is seen will improvement begin. Many people are afraid of budgeting because they feel that their freedom will end. But the reality is the opposite. A budget does not reduce freedom, it reduces fear. The person who knows that he has an emergency fund, has insurance, debt is under control, and investment is going on, feels less guilty even while spending. Planning makes the present better too. Now imagine, as soon as the salary comes, the entire money is lying in a single checking account. Rent will also go from there, grocery too, shopping too, investment too, and impulsive spending too. This setup itself creates confusion. The smart way is that money be divided into different buckets. Necessary expenses, emergency fund, goal saving, investment, and flexible spending. When the role of every bucket is clear, the decision becomes easy. If a bonus came, instead of keeping it directly in the spending account, give it a pause first. Some part can go into debt reduction, some into an emergency fund, some into investment, and a small part into guilt-free enjoyment. This pause is very powerful. When money is not immediately available, the impulse becomes weak. A thing that was looking irresistible today does not look that necessary 4 days later. That is why many people use automatic transfer. As soon as the salary comes, saving or investment gets separated. Then whatever remains, the lifestyle is managed within that. This can be called the habit of pay yourself first. Financial success does not always come from a big income. Many times, it comes from small friction, meaning such small barriers that stop you from a wrong decision, like card limit control, shopping app uninstall, or the 24-hour rule. The 24-hour rule is simple. If a big expense is to be made, do not do it immediately. Wait for 1 day. If the next day too it feels like a necessity and the budget allows, then take the decision. Excitement will reduce, clarity will increase. This same rule comes in use in investment too. Someone said that this stock will double, this crypto will run, this scheme will give a guaranteed return. Stopping before putting in money immediately is your first protection. Because losing money is not just a financial loss. Along with it comes regret, comes self-doubt, and sometimes family trust also gets shaken. Therefore, every big financial step demands slow thinking. Both fast thinking and slow thinking work in our brain. Fast thinking gives a quick reaction. Slow thinking asks questions. In money matters, fast thinking looks convenient, but slow thinking is safer. You do not have to take every decision at an expert level. Just some basic questions have to be asked. Is this expense a necessity or a desire? Do I understand this investment, or am I doing it just by hearing about it? What is the worst case? If the worst case can shake the foundation of your house, then the decision is not small. Even if the amount looks small, if the risk is big, a pause is necessary. The second big part of financial planning is understanding net worth. Income tells how much money is coming. Net worth tells where you actually stand. Calculating net worth is not difficult. Add your assets like cash, bank balance, investments, property value, gold, business value. Then subtract liabilities like loan, credit card dues, personal debt, and pending payments. Many people, despite high income, hold a low net worth because expenses and debt eat up their income. On the other hand, some people become strong even on a normal salary because their system is disciplined. Net worth is your financial report card, but not daily marks. There is no need to look at it every day. Looking once in a month or quarter is enough so that the direction is understood. Now comes the talk of retirement. Many people consider retirement a distant thing. But more important than retirement age is the retirement number. Meaning, how much income do you need to run the lifestyle in the future? If you want to stop work at the age of 60, planning cannot begin at 55. Retirement is a long game. In it, compounding, health cost, inflation, and life expectancy all come together. A big lesson from 𝐮𝐭𝐞𝐬's retirement research is that people do not retire happy just by accumulating money. They also need the reliability of income, confidence of spending, health, relationships, and a purpose. Meaning, retirement planning is not just a race to create a corpus. This is the planning of that life where salary will not come, but expenses will not stop. And perhaps the medical cost might be more than before. Many retirees are afraid to spend despite having money. They feel that the money might get finished. This too is the fear of the financial brain. Shifting from saving mode to spending mode is not easy. Therefore, at a young age itself, retirement should be seen not like a fear, but like a design. Where do you want to live? How much to travel? What safety is needed for parents, spouse, children, and health? The answer to whether a house has to be taken on rent or bought should also not come from emotion. Society says that one's own house is security, but finance asks, what is the location, loan, job stability, rent yield, and opportunity cost? Buying a house is not wrong. Living on rent is also not wrong. It becomes wrong when the decision is taken only out of pressure. Everyone is buying is no financial logic. For an entrepreneur, money management is even more necessary because business income can be irregular. If the business account and personal account get mixed up, the profit also becomes an illusion. For a student, this skill is necessary because an education loan, first salary, lifestyle upgrade, and credit card offers can become the initial traps of life. The habit of the beginning decides the wealth ahead. For parents, planning is necessary because the children's future is a decision filled with emotions. Every parent wants to give the best, but a balance between education planning and retirement planning is necessary. If parents keep funding every demand of the children by sacrificing their own retirement, then in the future, those same children can come under emotional and financial pressure. A self-reliant retirement is a gift for the children too. Money management does not mean miserliness. It means that today's happiness and tomorrow's security both get a place. Living only for the future is also a problem, and living only for today is too. In a healthy plan, spending also exists. But that is planned spending. Like a travel fund, festival fund, learning fund, family outing fund. When the expense is already planned, the guilt is less and enjoyment is more. An emergency fund is the safety belt of this entire story. When a sudden job loss, medical bill, repair, or business slowdown comes, then the emergency fund saves from panic decisions. An emergency fund is not an investment. Its job is not to give a high return but to give immediate support. This money comes in use at that time when other options are either expensive or risky. Debt too controls the financial brain. High interest debt makes a human being spend the future's income today itself. The minimum payment of a credit card gives comfort but increases the burden deep inside. Therefore, the first mission in money management should be to understand dangerous debt. Every loan is not bad, but every loan definitely creates a claim on future income. Insurance too is a part of planning. Many people buy investment but forget risk protection. A medical emergency or income loss can shake the entire financial plan. Tax planning is necessary too, but buying a wrong product in the attempt to save tax is not right. First understand the product, then look at the tax benefit. Investing just for a deduction can often become a costly mistake. Now come back to the financial brain. Your brain wants comfort. It avoids difficult conversations. It does not want to look at the budget, ignores the debt statement, and puts off future planning for later. But money problems do not become small by ignoring them. They compound. Just as investment grows in the same way, bad habits also grow. The only difference is that one creates wealth, the other stress. Therefore, a small step is needed today. Write down your net worth, look at last month's expenses, set an automatic saving, close one unnecessary subscription, and place a pause on some big decision. Financial freedom is not a jackpot of a single day. It is the result of 1,000 small decisions. Every time when you choose clarity instead of emotion, your future becomes a little strong. The real lesson of this part is exactly this, that before managing money, one has to manage oneself. Before the account balance, behavior has to be balanced. Because the biggest financial tool is your brain itself. If your brain is running on fear, greed, and comparison, then even a high income can fall short. But if the brain is running on discipline, patience, and awareness, then even a limited income can catch a direction. Today's story stops here, but the question is still remaining. If we have understood the financial brain, then what will be the next step? How should money be managed in the different stages of life? Because the money strategy of a 20-year-old student, a 35-year-old parent, a 45-year-old entrepreneur, and a 60-year-old retiree cannot be the same. In the next part, the story will move ahead from right here. And perhaps right there you will understand that money is not just a thing to be earned. Money is a thing to be run according to the life cycle. The mistake is just this, that most people learn this lesson very late.
If this video has taught you something new, or if you feel this information should reach more people, don't forget to like and share the video. Your small share can become valuable and useful information for someone else. If you have any questions related to this topic, or if you would like to share your opinion with us, be sure to write in the comment box. We read every question and suggestion from you, because your feedback inspires us to create better content. And if you want to keep receiving such interesting and reliable information about business, the economy, and the world in the future, then don't forget to subscribe to our channel GRT Business and also press the bell icon so that you get notifications of every new video directly. At GRT Business, we always strive to provide you with accurate, balanced, and reliable information. Our news and analysis are prepared based on information obtained from various news agencies, public sources, and public opinion. We make every effort to verify and validate each fact as much as possible. But in case of any possible error or dispute, the responsibility lies with the respective sources. Our only aim is to present you with a correct and trustworthy perspective so that you can understand any topic better.